Ever wonder about those really wild swings you see in stock prices sometimes?
Yeah.
Definitely.
Well, sometimes companies aren't just, riding the market wave. They're actually behind the scenes, actively reshaping their own shares.
Kind of moving the pieces around.
Exactly, sort of chopping them up or maybe even squeezing them together. And these moves, they can make a stock look totally different.
But the underlying value often doesn't change a bit.
Right. It's like a financial magic almost,
Mm.
but with spreadsheets.
Yeah.
So today, we're plunging right into the core of these tools, stock splits and reverse stock splits.
Good stuff. Important to understand.
Our mission is basically to demystify them, figure out why companies use them, and then we're going to zero in on a specific case that's been getting a lot of attention.
Yeah.
SoundHound AI, ticker SOU.
Yes, SoundHound. Definitely been in the news.
It's an up-and-coming AI stock, really caught the market's eye, partly because, well, it's been pretty volatile.
Volatility is key there. So, for you, our listener, the big question we're tackling is, does SoundHound AI look like it's heading for one of these split moves? Let's really unpack this.
Absolutely. Because understanding these maneuvers is, well, it's just key to being genuinely informed about what's happening in the market.
I think a lot of people hear stock split or reverse split, and, maybe they think it sounds super complicated.
Or even scary, like something's wrong.
Yeah, exactly. But what do these terms really mean for a company, and maybe more importantly, for your investment?
Okay, so look, it's actually far simpler than it sounds on the surface. Both stock splits and reverse stock splits, they're just tools.
Tools that companies use.
Publicly traded companies, yeah. They use them to adjust their share price and the total number of shares out there.
Okay.
But here's the crucial point, the thing you really need to get. Neither move changes the company's overall market capitalization.
Meaning the total value of the company.
Correct. Or the equity value of your position as an investor. Think of it like
Yeah.
a pie.
Okay, pie. I like pie.
Right. So whether you cut that pie into 8 big slices or 16 smaller ones, you still have the same amount of pie, don't you?
Yeah, you still have the whole pie.
Exactly. The total value is precisely the same. It's just the number of pieces, and maybe their individual price tags change. That's it.
That pie analogy really clicks, makes it super clear. So just to be sure I'm following this, even though the number of shares I hold might change, the actual slice of the company I own and its total dollar value stays exactly the same.
Precisely. Let's put some quick numbers on it from our sources. Say you own 20 shares of a stock.
Okay.
And each share is trading at, say, $200. So your total investment is worth $4,000.
Got it. 20 shares, $200 each, $4,000 total.
Right. Now, if the company announces a 2-for-1 stock split, suddenly you own 40 shares.
Doubled my shares.
Yep. But to keep your original $4,000 investment value, because remember, the company itself hasn't fundamentally changed, the share price automatically adjusts downwards to $100 per share in this case. It's purely an accounting adjustment. Your wealth is identical.
Wow.
But the stock feels different, right? It feels more affordable.
Yeah, $100 feels way more approachable than $200.
And that psychological bit, that's often the real driver behind these regular splits.
That's a huge insight.
Yeah.
Because my reaction might be, oh, great, more shares. I'm richer.
But you're not. Not really.
It's just repackaging.
Yeah.
And a reverse split. That's just the opposite then.
Exactly, the mirror image. A reverse split increases the share price by decreasing the number of shares out there.
Fewer shares, higher price.
Again, no change to your total equity value. So if you had those 40 shares at $100 each from our last example,
$4,000 total,
and the company did a 1-for-2 reverse split, you'd end up back with 20 shares.
Ah, okay.
And each share would now be worth $200 again. Still $4,000 total. It just consolidates your shares, makes them fewer but pricier.
Okay, I think I've got the what. So if the total value doesn't actually change, why do companies even bother? Like, what's the point of these maneuvers?
Now that's where it gets really interesting.
Yeah, this feels like strategy time.
It absolutely is. The reasons reveal a lot about corporate strategy, about managing perception in the market.
So let's start with the regular split. Why do that?
Okay, for a regular stock split, the reasons are usually pretty positive signals, actually.
Like, things are going well?
Generally, yeah.
Yeah.
Companies typically do these splits when their stock price is really soared. Trading for hundreds, maybe even thousands of dollars per share.
Right, like some of the big tech names we've seen.
Exactly. And a lower price per share can make the stock feel more attainable, more affordable to individual investors.
Less intimidating to buy, maybe?
That's a big part of it. I mean, sure, you can often buy fractional shares these days, but there's still a psychological hurdle for some people when a single share costs, like, more than their phone bill.
Yeah, that makes a lot of sense. A lower sticker price just feels more accessible, maybe brings in more small investors.
It can broaden the investor base, yeah?
Is there any other benefit to a regular split, besides just making it look cheaper?
There is, and it's quite significant, increased liquidity.
Liquidity, meaning easier to buy and sell.
Precisely. A greater number of shares outstanding often leads to more trading activity, more volume.
Okay.
And that generally makes the stock easier to buy and sell quickly without causing big price jumps or drops just from your own trade.
Ah, so smoother trading.
Yeah. If there are more shares floating around, it's usually easier to find a buyer or seller when you need one at a fair price. It helps everyone.
Okay, that's a clear win for regular splits. But what about the other side? Why do a reverse split? That one sounds less cheerful.
You're right to pick up on that. It's definitely a different vibe. While a regular split often signals success, a reverse split is usually a response to, well, challenges.
Okay. What kind of challenges?
The primary reason, and honestly it's often a make-or-break one for companies, is meeting the rules of the major stock exchanges.
Like the New York Stock Exchange or NASDAQ.
Exactly those.
Oh.
Both have listing requirements, and one big one is often called the $1 rule.
The $1 rule. Sounds ominous.
It kind of is. If a stock trades below $1 per share for too long, usually it's 30 consecutive trading days, it risks being delisted, kicked off the exchange.
Delisted. Wow. What does that actually mean for a company? That sounds bad.
Oh, it is serious.
Yeah.
Being delisted means the stock gets removed from that major exchange. It often ends up on, like, the over-the-counter markets, the OTC.
Which is not as good.
Not nearly as good. It drastically reduces the stock's visibility. Its liquidity dries up. Big institutional investors often can't or won't touch it.
So it becomes harder to trade, harder to raise money.
Incredibly difficult.
Yeah.
So a reverse split can be a strategic, almost essential move to boost the share price back above that $1 minimum.
Just to stay listed.
Just to stay listed, to maintain that status. If you connect it to the bigger picture, it's about the company trying to preserve its standing, maybe signal confidence that they can turn things around even if they're struggling.
It's a tactical move to stay in the game on the big board.
Exactly. It's like a financial lifeline sometimes, just trying to stay above that dollar mark.
Wow. That's a pretty stark reality check for some companies, isn't it? I think I remember hearing about a tech company years back that just barely avoided delisting with a last-minute reverse split. Really shows the pressure.
Absolutely. The stakes are high.
Okay, so we've got the foundation now. Splits, reverse splits, the why. Let's pivot to the company you asked about. SoundHound AI.
Right. SOUN.
Their journey seems like a perfect real-world case study for all this. So first off, what exactly is SoundHound AI? What do they do?
Okay, so SoundHound AI, they're a conversational artificial intelligence company.
Conversational AI, like chatbots and voice assistants.
Pretty much. They specialize in providing advanced AI that understands voice and natural language. The goal is to enhance customer experiences.
How so? Where would I see their tech?
Well, our sources say you'd find their technology powering chatbots in cars, for example.
Ah, like talking to my car's navigation.
Could be. Or helping you order food or services using your voice, assisting businesses with handling customer service issues more efficiently.
Okay.
Essentially, they're building the smarts behind more natural interactions between us and technology. Think of it as the invisible intelligence making voice commands actually work well.
Gotcha. So definitely in that booming AI space, which explains some of the buzz.
For sure.
But as we mentioned, our sources point out that while SoundHound might have delivered good returns over 5 years, the stock's also been incredibly volatile.
That's the key word again, volatile.
And that volatility is exactly why some investors are asking about a potential split, right? And why we're digging in today. So let's look at where they stand. What are the metrics as of, say, September 3rd, 2025?
Okay, yeah. As of that date, SoundHound AI had a market cap around $5 billion.
Okay, decent size.
Yeah. The stock price was sitting at $12.75 per share. Though, worth noting, it did drop about 5% on that particular day.
Just shows the movement, right?
Exactly. And when you look at its 52-week range, that really tells the story. It went from a low of $4.32.
Wow, okay.
All the way up to a high of $24.98.
That is a huge swing. Really illustrates that volatility.
Absolutely. Now, thinking about exchange compliance, that $1 rule we talked about,
Yeah.
well, $12.75, they're comfortably above that $1 minimum. So there's no immediate need for a reverse split just to stay listed right now.
Okay, so no panic on that front.
Not right now.
Yeah.
However, our research shows that within the last 5 years, the stock actually did get close to $1 per share. On several occasions, in fact.
Okay. So that's the historical context.
That's the context. And it totally explains why people might be speculating about a reverse split. Even if the price is okay today, history matters.
That's really crucial because it shows why investors might still have that split possibility in the back of their minds.
Okay, so beyond the share price and its history, what else did the source tell us about SoundHound's situation? Anything about investor sentiment, maybe?
Yeah, a couple of other interesting details came up. First, liquidity. Most of SoundHound AI's outstanding shares are publicly traded. They're in the float.
Meaning they're easily available to buy and sell.
Generally, yes. Which suggests that liquidity probably isn't a major worry for them right now.
So a regular split to boost liquidity probably isn't high on their list.
Seems unlikely based on that. But here's a really fascinating detail for you to chew on.
Oh, go on.
Short interest. Over 30% of the public float.
30%.
Yeah. Over 30% is being shorted by investors.
Wow. Okay, hold on. For anyone listening who's not familiar, can you quickly unpack what short interest means and why 30% is, well, kind of a big deal?
Sure. So when investors short a stock, they're basically betting its price will go down.
Right. They borrow shares, sell them. Exactly. They borrow shares, sell them on the open market, hoping to buy them back later at a lower price. Then they return the borrowed shares to the lender and pocket the difference as profit.
Betting against the company, essentially.
That's the idea. So a 30% short interest means that almost a third of all the shares readily available for public trading are held by people expecting the stock to fall.
That sounds incredibly high.
It is quite high, yeah. It signals significant bearish sentiment, a lot of doubt from a big chunk of the market.
What does that high short interest potentially lead to?
Well, it sets the stage for something called a short squeeze.
Ah, I've heard of those, like with GameStop.
That was a famous example, yes. If the stock price does start to rise unexpectedly, those short sellers start losing money. They might rush to buy back shares to cut their losses.
Which pushes the price up further.
Exactly. Creating this rapid upward spiral. It just adds another potential layer of, you guessed it, volatility to an already volatile stock.
That's a fantastic insight. Really highlights how polarized the views on SoundHound might be. You've got bulls and bears lining up.
Definitely suggests a tug of war in market opinion.
Okay, so shifting gears slightly, what about their actual performance, their financials? What did the Q2 earnings report show?
Right. The earnings, that was a bit of a mixed bag, but you could argue largely encouraging for a company in high growth mode.
Okay.
On the one hand, they reported revenue of nearly $43 million.
Yeah.
And according to our analysis, that was, quote, rocketing 217% year over year.
Wow. 217% revenue growth. That's massive.
Huge. Shows really rapid expansion, which is what you want to see in this kind of company.
But there's a but, I sense.
There is. On the flip side, their net loss widened. It was in $1.19 per share compared to $1.11 a year ago. So losing more money on a per share basis.
Okay, not ideal.
However, their adjusted net loss, which often strips out things like stock-based compensation or one-off items, was actually better. It came in at 0 and 3 cents per share.
And how did that compare?
That was a penny better than the previous year's adjusted loss. So improvement on that adjusted metric.
So it really raises that classic question for growth stocks, doesn't it?
Absolutely. How do you, the investor, weigh that incredible triple-digit revenue growth against the fact that they're still losing money overall?
Yeah. Are you betting on the growth story translating into future profits?
That's the bet many investors in these types of tech companies are making. Future profitability versus current losses. It's a very common dynamic.
Okay, so we have this really complex picture for SoundHound AI. Past volatility getting close to $1. Current price is okay, but huge 52-week range. Massive revenue growth, but still posting losses. And this incredibly high 30% short interest.
Yeah, lots of moving parts.
So putting it all together, after weighing all these factors, what did our source ultimately conclude? What's the likelihood of SoundHound actually doing a split, regular or reverse anytime soon?
Well, based on the comprehensive review, looking at where things stand right now, the author of our source material doesn't see SoundHound AI, quote, jumping to do any kind of stock split or reverse split in the near future.
Okay, so no split imminent, according to them.
That's the assessment. And there's also no evidence that SoundHound has done any splits in the past either. It doesn't seem to be part of their usual financial playbook.
Makes sense.
A reverse split, like we discussed, would really only become a pressing need if the company saw just a drastic plunge in value.
Like if the whole AI sector crashed
Hmm.
or something went really wrong specifically at SoundHound.
Exactly. Those kinds of major negative events. And those are scenarios that the author just deems not likely right now.
So it's a good example of analysts not just looking at past wobbles, but at the current fundamentals and the broader market.
Precisely. Looking at the whole forest, not just the one shaky tree from the past. Making projections based on the current landscape.
Okay, so there you have it. We've taken a deep dive into stock splits and reverse splits. We've hopefully demystified them a bit. They're strategic tools, not changes to fundamental value, adjusting how a stock appears.
Right. Adjusting perception and maybe accessibility or compliance.
And when we apply that lens to SoundHound AI, well, it's definitely been a wild ride. Impressive growth, notable volatility, lots of debate. But our sources suggest a split either way isn't really on the immediate horizon for them. It's a good reminder that market perception and strategy often count just as much as the raw numbers.
It really is. And this whole deep dive, it highlights how a company's past volatility can definitely spark speculation, right?
For sure.
But it's so crucial, as you said, to look at the current fundamentals, the current market context. And thinking about that really high short interest in SoundHound we discussed, here's a thought for you to ponder. What do you think that high percentage tells us about the drastically different expectations investors have for SoundHound's future? And how might that fundamental disagreement, that clash of opinions, impact the stock's performance going forward? Completely separate from whether a split ever happens or not.
That's a great question. Lots for you to think about as you continue to navigate the markets. Thanks for joining us on the deep dive.
Keep exploring. Stay informed.
We'll catch you next time.